This is Matt Russell from the FX Power Course, and welcome to the DailyFX walkthrough.
So here are the four pairs that I will be discussing this evening: the Kiwi, Aussie, Euro, and the dollar yen. So let's go ahead and pull up the charts. The first chart is the Kiwi dollar. This is an hourly chart, and this is the channel that I have been using for the past 12 or 13 reports now. As I was mentioning yesterday, or two reports back, we should take our profits, and yesterday I was mentioning how we might take shots at long trades with very controlled risk, and that's what happened yesterday. I actually entered into the trade that I was speaking about during the report, and I was stopped out on this candle here, but for a very small loss, about 25, 30 pip loss, and there's absolutely nothing wrong with that. As I was mentioning yesterday, just taking a shot on a long trade because I think there's a good chance for a reversal. With that being said, there's also a good chance that this downtrend will continue, shaking everybody out until there is that reversal. So right now, viewing the chart, my next shot, my next trade setup might be a inverse head and shoulder pattern, again on the hourly chart here. Let me zoom out a little so you get a better view. This would be the left shoulder, this candle right here. This would be the head, and now we might look for a move to the right shoulder, which is about 53.15, and that would be a good risk-reward trade if prices come down to that 53.15 area. The next chart is the Aussie dollar. Not much has changed here. I was mentioning how that previous support line might act as resistance, and I mentioned in yesterday's report how prices did come close to that line, but not close enough to generate a favorable risk-to-reward entry. Looking at the daily chart here, if we zoom in a little bit, I would call this a borderline doji. Ideally, the open and close would be a little closer together for this to be a more textbook pattern. But with that being said, about the way I feel about the U.S. dollar as a whole here, how I think that the dollar is making at least a short-term top, we use this doji as a basis for a long trade. We would place our stop right beneath the low of the doji candle. The low of the doji candle is 65.36 roughly. So what we can do if prices come down near that 65.36 area, look to enter and place our stop beneath 65.36, which is the low of that doji candle. The next chart is the euro dollar. Not much has changed here. This is the daily chart. Let me zoom into the 60-minute chart, and prices have stayed within this channel. It's a pretty broad channel, particularly for an hourly chart, but I'm still waiting for prices to come down and test that lower channel line because I can't find any decent risk-reward entries on this pair as we speak. So I'm just keeping up those lines and waiting for prices to come down and test that lower support line. The next chart is the dollar yen, and the dollar yen, this is the daily chart. I've removed that resistance line which failed, and now prices went above it, went back beneath it, then went back above it, and so I've taken it off the radar screen in terms of how to view the pair. If we zoom in a little closer to the 60-minute chart, a similar thing might have happened here. Comparing it to the Kiwi dollar, as I was mentioning before, this could be an inverse head and shoulder pattern as well. It's not very clean. The left shoulder and the head would be very close together. This would be the left shoulder here. This would be the head, and this conceivably could be the right shoulder. So moving forward, we might look to get an entry near that 88.60 area, which would be the line connecting both the left and right shoulders, and that would be a favorable risk to reward. Also, if we're speaking about a very short-term trade here, we might take a move above that 90 figure as a breakout trade, but again, this is a very short-term trade idea. Dollar yen is a tricky pair. It can easily snap back beneath the previous resistance line, stopping us out, so we want to be very careful. And again, this is a very short-term trade idea, but I could see maybe another 100 pip or so rally here on a breakout above that 90 figure. So I'd wait for an hourly close above the 90 figure and possibly enter on the long side, placing the stop back inside, back below that 90 figure. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.